So here, before we get deeper into some of the Chinese data and Asian data in general, we just want to provide an update on some of the things that are happening in between India and China in the disputed areas. So we've talked about it before, and then tomorrow we're going to talk a bit more about what happened in the UAE in terms of the three fuel tankers, the tank trucks blowing up. You know, what happened with the CN pipeline and what does that mean for production and flow through and availability of oil? Because those are all key things, but it's a bit more oil centric. So we just want to keep that in the EIA show. But here, when we look at some of the pieces of what has happened between India and China in this contested region. So after 20 months, 14 talks, India and China continue to be in a stalemate regarding East Ladakh. In the meanwhile, China's construction and development activity around the area of contention continue to highlight an intent to stay. Some broad details here, because when we look at where things are going, so they continue, and again, this is not just China. They're both building out, and they're meeting each other essentially tit for tat when you're looking at what is being built and created. So we have military strong points in the area have been reinforced with new accommodations facilities. You look at fresh military bases. Then when you look at additional air bases, heliports, an airport in general. And then when you look at the some cities even being converted into support and staging areas, a lot of these things are support components and essentially showing that you're digging in. You're not digging in exactly on the front lines, but you're digging in just enough where this would be either your launching point or in your fallback point. So this is the key piece that we always want to look at, and this is why we don't think this is going away anytime soon and remains a huge friction point that really can't be ignored, especially when we get into the spring season. This is just zooming in on one of those pieces in Ladakh, because the development of this bridge in Pangsao appears to strengthen the idea of permanency being established by Beijing in the region, committing to its territorial claims with India by modifying unforgiving landscape in its favor. So here's where it's just that. So there's a big lake, and this just speeds across it. So again, there's ways around it. It's just, this is something that when speed is of the essence, you need to get reinforcements back. You need to retreat quickly. These are going to be key assets. So again, just showing the investment in the region from both sides just shows that even though there's talks continue or are ongoing, there's really no movement that has happened, keeping things fairly sticky in that area. So now China's 2021 agriculture imports were larger than in 2020. I think that's not surprising to anyone. The Jan-December soy volume of 96.5 million tons is the second best after last year. So even though it was down year over year, it's still near records, where corn imports reached 28.35 million tons, up 150% from 2020. So you're just getting an idea of how China continues to absorb a significant amount of capacity. And this is not something that's going away, creating additional shortfalls, which now is going to be made worse because the yields are going down, not up, versus last year. So they're just going to make less product available, even though demand continues to go up, which again is creating some of these pressure points. Now I'm not gonna go through every single piece on this chart. We'll go through them as we go through the remainder of the section. As we said on the FSC show, exports came in slightly above expectations at 20.9%, but imports missed estimates. They were expected to be at 27.8, coming at 19.5, which is really that leading indicator for the pressure and problems that we see happening going into this year, into January, but beyond. As imports slow, it's showing an issue with not only local consumption, but also that slowdown that we've seen in new orders, new export orders, which is because they're a country that imports raw materials, semi-finished goods, to export semi-finished goods, final goods, finished goods, and that import is that leading indicator for where exports are going to go. New home prices fell again, not as steep as the prior month, but still a negative move, which is another underlying issue. We did get some reaction from the PBOC. The 1-year medium-term lending facility came down 10 basis points from 2.95% to 2.85%. We'll talk about that more in a minute. Property investment missed estimates, came in at 4.4% versus the 5.2. Industrial production, slight miss, depending on how we're looking at year to date, just small, but industrial production year over year was still stronger than expected, coming in at 4.3% versus 3.7. Fixed asset investment came in a bit stronger, was expected at 4.8%, came in at 4.9. So GDP was expected at 8%, came in at 8.1. We got the slowdown that we were expecting quarter over quarter. It was still a little bit of growth, but getting to that year-to-date number again, where we can talk about some of the mental gymnastics and some of the numbers that we had to adjust to get there, because we've been covering this data weekly. Like, we have snapshots of this. Like, if you add that all together, is it growth? Yes. They didn't see a decline, but is it 8%? And remember, the goal was to grow at this level, and that's where, as we go forward, the ability to kind of massage these numbers goes away from the perspective of retail sales, because retail sales year over year were expected at 3.8%. They came in at 1.7%. So after all the talk about the consumer, all the talk about stimulating the consumer, they still can't get there, which is where we continue to see a lot of these pressure points as we go into the new year. Now, the growth rate is slowing. So household incomes are growing at a snail's pace and domestic consumption is falling. Investment is weak, not so much on the foreign investment, but when we're looking at the real estate sector continues to struggle under policy-driven de-risking. Export growth, which has been going very strong, is also slowing. The recent arrival of Omicron variant will test the leadership zero COVID approach, and all this with the once every 5-year party leadership reshuffle, the 20th Party Congress due to take place this fall. And then on Tuesday, she told, and then thinking about, again, all this is happening, but there's still an importance on solidifying power. She told the Central Commission for Discipline Inspection, the CCDI, to maintain zero tolerance for corruption. There is still a long way to go to effectively tackle the more invisible, deep-rooted corruption, and we still have a long way to go. The CDI is the party's obviously top disciplinary body. All members of the policymaking standing committee attended Tuesday's meeting. The high-level showing suggests there shall be no rest for the watchdog. So again, more of those pressure points. So let's think about some of that GDP numbers and where does it mean from here. So when we dive into the data, the secondary sector output growth slowed to 2.5% year over year in real terms in the final 3 months of the year. This was the weakest outside of Q1 2020 since 1992. So again, that output growth, you're seeing the slowdowns just beneath the surface. Real estate has historically been the driver of secondary sector growth, but as this has faltered, so too has industrial output. The fall in real estate investment also meant that gross capital formation was a big drag on GDP growth. It accounted for minus 11.6% of real GDP growth in Q4. Weaker real estate was likely contributed to slower growth in the tertiary sectors. Value-added output growth here slowed from 5.4% in real terms in Q3 to 4.6%. So again, that movement down that we continue to see. Main reason for the pullback in service sector activity was weak consumer spending. Separate data from the Stats Bureau shows that household discretionary income growth slipped to 5.4% in Q4, down from 6.3% year-over-year growth in previous quarter. So again, things are continue to get a bit worse. And without exports contributed 26.4% of real GDP growth in Q4, which is not going to continue, which again is where we continue to see the biggest headwind, which is why we talk about those slowdowns going into next year. But what's being done? So the PBOC is not sitting idle, but we have to appreciate what they're doing and what are the impacts it's having. So the PBOC medium-term lending facility 1-year interest rate came down 10 basis points, but it never went back up post-COVID. So there was never a tightening. So when you're thinking about the impacts or the law of diminishing returns, that's where it starts to bite. They've already cut fees. They've already cut taxes. They've already cut rates in 2020. And they're doing it again. So what is the impact and benefit really going to be throughout this time period? The PBOC reverse purchase notes 7-day rate dropped also 10 basis points to 2.1%. Again, same thing as we said with the interest rate. But when you look at the money growth is accelerating, but lending is not. And as we talked about at the end of last year, there's a lot of balance sheet changing rules that have changed. So even though there's more money growth, a lot of that is locked up on the balance sheet because of the changes in wealth management products, because of the changes in local government financial vehicles, because of the changes in retail. So yes, money growth is there, but it doesn't mean that the banks can turn around and lend it because we're, again, not seeing the lending growth that should have been expected. The muted credit growth is across the board with total credit, total credit, bank loans, property loans, all coming down. But what does that mean going forward? Because the PBOC is taking action. And as we've been saying, they're just going to stop it from going much lower. So China construction activity, when you look at it across the trend, China floor space sold, again, against the trend. Property market shows early sign of stabilization. Construction activity index slightly rebounded in December for the first time in 9 months. And then demand for residential spaces increased for a second consecutive month. So again, stabilizing. It's not a growth perspective. It's just we're starting to see it stabilize. You're seeing it already starting to taper off a bit. It's still going to move. You're still 16% below trend on construction activity, 22% below on space sold. And now you have Omicron picking up. You have the renewed pressure on zero tolerance. You have the Olympics coming up, keeping the zero tolerance. You have President Xi looking to become president for another round. These are all pressure points that we keep talking about. Now, keeping foreign trade and investment stable has been a series priority. So in 2021, the amount of FDI reached a record 1.14 trillion, a 14.9% year-over-year increase. That's something where there was a bit of a makeup number because there was a slowdown in 2020. These stats stood out. FDI in high-tech manufacturing increased 17.1%, and FDI in high-tech service sector rose 19.2%. So again, how much of this is going to continue as the pressure mounts? We have new legislation that is sanctioning China, and they're going to reciprocate. They're not going to stand still in this battle. And that's why we have to look at how much of this gets redirected into some of these other areas, which we think is very possible, especially on the ASEAN front. So then when you look at that OECD diffusion index, countries with rising leading indicators and China credit impulse. So it gives you an idea that there's still some of that downward movement at leading indicators, but it's going to start to reach a floor soon. So the main driver of the slowdown has been China. The credit impulse leads global growth momentum by 6 months, which suggests the slowdown has further to go. But December data out of China is encouraging. You're still not out of the woods, but again, and this is what we've been saying, it's just going to stop going down. They always put additional liquidity into the market going into year end. They always put additional liquidity into the market going into the Lunar New Year, which is the first, from February 1st to February 15th. So we're seeing normal things, but how much of this credit, how much of this cash stays in the system? Which again leads to some of the growth issues. So now when you look at China's growth slows with retail sales weakening more than expected. So the graph is helpful in the way that you're showing that the China's surpluses seem broadly to contract in periods in which the growth in retail sales outpaces growth in GDP, and expand in periods in which growth in GDP outpaces growth in retail sales. It's a problem when they're happening together because they're both slowing. So that's where we see a lot of these different pressure points, which this isn't just coincidence. When you're looking at imports and exports, confusing rising exports with a rising trade surplus isn't the case, because there are all sorts of COVID-related reasons why Chinese exports have risen, but these don't explain rising surpluses. If enough of export revenue were distributed to workers, the resulting increase in their consumption would have led directly or indirectly to an increase in imports. That's what we're saying. Imports come in to maintain exports, but imports come in to supply the consumer. The consumer is still struggling, which we've continued to see time and time again. Imports consistent with that. But again, it seems to confuse people. And imports didn't rise as quickly because there was nothing the Chinese wanted to import. And again, that's false, because people are always looking to import something. People are always looking to buy something. And if you don't have the money to do so, the job to do so, that's when you start to get that knock-on effect when we're looking at consumption going forward. So if rising exports aren't matched with rising imports, that can only be because of the way income is distributed. The idea that China runs a surplus because China doesn't want to buy more different products is just wrong. And that's what we continue to beat home and drive home when we're looking at exports and imports at every country, not just China, because it's a very important piece that at times I think is misconstrued or not understood as much at the both retail sector, but even institutional investors and people at the corporate level. But the point is that China's huge trade surplus, as the PBOC for one seems to recognize, does not indicate a strong economy. It indicates the difficulty China is having in rebalancing their economy, because remember, they want to go more towards consumption, which we're just not getting. Now, when we look at why we're not getting that, well, let's look at what's happened with the China USD High Yield Index. We have property developer in China, Oyan, says will not make payments of remaining principal and last installment of interest of January 2022 notes. As of Tuesday, People's Bank of China Vice Governor Lau said that there will still be room, albeit not all that much, for proactive monetary policy, because they still don't have the capacity to do so. On Monday, again, the PBOC cut interest rates on the medium-term facility, first time since April 2020. Over the past few months, the central bank has taken multiple but very targeted measures to increase liquidity at the margin. And that's why, again, slowing down the decline of credit impulses, starting to increase, but not too much. Two respective 0.5 percentage point cuts to banks' reserve requirement ratios in July and December, lowering the relending rate for agriculture and small business loans in December. Maintaining overall liquidity volume and widening the monetary policy toolbox isn't odd, especially for this time of year. But the PBOC has said and shown that it isn't currently interested in large stimulus. Instead, the central bank will maintain a targeted support to the segments of the economy that need it most and whose developments Beijing is prioritizing. So again, we don't see this huge backdrop. But one of the things that we want to point out is, well, where are some like Country Garden Holdings getting taken to the woodshed? But what is happening? So if you remember, there was an article that came out highlighting that they're loosening escrow, the use of escrow funds again, which just means that pre-sale escrow money can be used to repay debt, take out loans, use as collateral, which is a positive. But what is it offsetting? So the total debt and the short answer is LGFVs, or the local government financial vehicles, are seeing more pressure and more restrictions, which was a key, was kind of the last bastion for these guys to property managers to get money. But if you take that away, you have to replace it somewhere. So they're loosening escrow as tightening LGFV. Remember, you got to look at both sides of both hands to make sure we understand what is happening. So the total debt of LGFV soared to about 53 trillion yuan, or 8.3 trillion US dollars at the end of 2020, which was 16 trillion in yuan in 2013, to give you an idea of the growth, according to Goldman Sachs, which is more than half the size of China's gross domestic product. That's big number. And that's something to be concerned about when there's such a struggle at the local government level. To help local governments beef up their spending power, Beijing has allowed them to sell some infrastructure bonds early, just as it did in past years. When they were trying to get the provinces to borrow and spend as quickly. But China plans to keep its 2022 quota for local government special bond sales unchanged for last year. Several of China's largest banks have become more selective about funding real estate projects by local governments, concerned that some are taking on too much risk after they replace private developers as key buyers of land, People Familiar said. At least 5 state-run banks have imposed new restrictions this year on loans to weaker LGFVs seeking to buy land and develop new real estate projects. Banks are being more stringent in assessing the financial strength of the local economy and sales prospects. Again, this is what we've been talking about on the LGFVs being used as a piece, and now it's finally getting published in Bloomberg, which is where that quote came from. But we've been talking about this for months and months and months, but it's now finally starting to become a bit more mainstream. Now, China's builders need to repay or refinance $99 billion in the debt this year. Real estate, local bonds, offshore maturities, you get an idea of just how sizable 22 is. China's property crisis is spilling over to its largest, strongest developers. That's a big problem because now the credit-worthy guys, the investment grade guys are now coming under the same amount of pressure. The best credits can last the longest, but as time goes by and the support doesn't come, even the strongest cannot survive. So when we look at the China consumption, again, looking at it against where things were trending, as we showed earlier, it was starting to weaken in 2019, as you can see here, and then accelerated through 2020. President Xi Jinping has successfully cooled many of the country's hottest property markets as part of his campaign to deliver common prosperity. Now, that was a quote from the SCMP. But the problem is with real estate prices so high, they have to decline by at least 50% and probably more relative to income if housing is to become affordable along the common prosperity front. But if that were to happen, it'd wipe out an amount of equal to well over 100% of current annual GDP, in turn would sharply reduce household wealth and with it household consumption further, which of course would not only hurt demand directly, but indirectly by undermining a great deal of previous investments. So this is the catch-22 we keep talking about, which is why it has to be a very slow and gradual process to try to rehabilitate where things sit and why we see that long-term slowdown in China. Now, when you look at social financing, annual change of adjusted total of social financing remains lackluster, which is why the activities indicators continuing to come down, that GDPs can then continue to slow as we go through Q1 and Q2, and social financing, while off the bottom, is kind of confirming our point where we're just going to go sideways and not really see a big bounce. But the weakness in China manufacturing employment can potentially be explained away after nearly 2 years of strength. China has preserved through off and on service job weakness for a while, but both sliding simultaneously is a problem. So you have manufacturing employment down, service employment down. But we're starting to see a little bit of a bounce in PMI new orders, but again, it's still at a fairly weak rate compared to where China credit impulses are, which is why we see that going sideways, and it's starting to show up in jobs. So not only is there a job issue, but the China population dynamics. On Monday, National Bureau of Statistics director revealed that domestic population growth was nearly flat in 2021. 10.62 million births recorded, a birth rate of 7.52 per 1,000, which is the lowest in PRC history. There were 10.14 million deaths, a mortality rate of 7.18 per 1,000. That puts 2021 population growth at under 500,000 people, or just 0.034%. The last time population growth fell this low was in 1960 amid a nationwide famine. This is a huge problem for industrial production, for inflation. All of these key pieces are all coming to a head at the same exact time, which is why we remain so concerned as to where things are going for China at this point. To get places faster, to try to offset this, The State Council on Tuesday published its 14th five-year plan for modern transport system development. The plan sets a bunch of targets: expand the high-speed rail system to 50,000 kilometers. Remember, that was put on pause. Expand and then up from 38,000. Expand the entire rail system to 165,000. That's from 146. Extend urban subway lines to 10,000 from 6,600. Expressways to 190,000 from 161. Expand high standard inland waterways to 18,500 from 16,100. But what is the issue with this? Who are you moving? And why are we spending all this? Or is this just a way to kind of prop up the government and prop up spending to, again, keep people busy, keep people active? But what is the yield on this? What is the return? Because we've already seen for every $3 invested or borrowed, they're only making $1. So how much of this kind of perpetual cycle can continue? Now moving this to the next level on other areas. Well, China credit impulse 12-month net change, as you can see, just based on where it is, versus the Japan machine tool orders. Japan machine tool orders were sharply down in December, and just based on trajectory, will continue to be under a bit of pressure. But when you look at what is happening on China's front, when we're looking at the hiring, so let's look at service sector going back to 2018 or even before 2017. Service sector has been slumping. Again, hiring has been a huge problem. And then it's a communist state. Who is supporting the people that can't get hired? Then, so you look at services still in contraction. Now let's look at people who are staying home. China's urban migrant workforce has declined during the pandemic. So who's doing the work? How is it getting done? And that's where we look at industrial production, where things are starting to slow down again. And it's getting even worse when you look at what is happening with Omicron and some of these forced restrictions. So then when you look at industrial jobs, China's industrial companies have reduced staffing. Again, this is putting more pressure on not only the local governments, but also the federal government that have to try to support these individuals. So all of this is, and then when you take this to the credit impulses bouncing, stop going down, but all of these headwinds coming into January, this is why we have such concern, not only for how things ended in 2021, which we were right especially when you dig into the numbers and look at the baseline slowdowns, we see that continuing well into 2022. Now, when you look at China new home prices month over month, another consistent decline, more pressure that we think is going to continue as they try to make things more affordable along common prosperity. But how much lower can it go before it becomes a much bigger issue on underlying growth? And then now switching a bit to other areas in the region, Japan Producer Price Index was expected at 8.8%, came in at 8.5%. Still that inflationary backdrop that we think is going to remain elevated and stay sideways. South Korea raised rates right along the expectation. Expectation was for 25 basis points, came right in at 1.25%. And we do think that you will get another as inflation remains an underlying problem, not only in South Korea, but everywhere, which again, leading to that slowdown that we keep highlighting. And then South Korea export price dipped a bit, but you can see just where we sit, still remaining elevated, still getting passed on. And then India industrial production dipped, and it's now below where it was in 2019. So we just want to watch to see if this progresses as COVID cases continue to rise in India, which could put a little bit of a damper on their growth and some near-term oil and oil product consumption. So that's all we have for you today. If you have any questions, please reach out to us either on Twitter. You can email me or find us in the comments section. Thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.